On June 23, 2026, the United States and Iran signed a memorandum of understanding. The Strait of Hormuz, the 21-mile choke point through which 20% of the world's oil supply flows, was reopened. Oil prices dropped, bond yields eased, stock markets rallied, and across financial media the same word appeared over and over again. Relief. History has a different word for this moment. It has seen it before many times, in many forms. And the word history uses is not relief, the word is intermission. Before examining the historical parallels, it's worth being precise about what was actually signed on June 23rd, because the distance between what markets priced and what was actually agreed is itself historically significant. A memorandum of understanding is not a treaty. It is not a binding legal agreement enforceable under international law. It is, in the most technical sense, a statement of intent, a document in which two parties record that they have agreed to have further discussions about something on terms to be negotiated later. The specific terms of the Iran Mao, as publicly reported, involved the United States ending its naval blockade of Iranian ports and Iran reopening the Strait of Hormuz in exchange. Both sides agreed to hold further discussions over the following 60 days on Iran's nuclear program. No details of those nuclear discussions were specified. No verification mechanisms were established. No consequences for non-compliance were defined. The deal was, in essence, an agreement to talk about having an agreement. Markets, as they typically do in moments of acute geopolitical stress relief, priced this as if it were a comprehensive, durable, verified resolution. Oil dropped sharply on the announcement. Treasury yields pulled back. Financial asset prices rose broadly. This response is understandable. It is also historically remarkably consistent and consistently unreliable as a predictor of what comes next. Financial history has a specific and well-documented phenomenon for what markets did on June 23, 2023. Economists and market historians call it deal euphoria, the temporary disproportionate repricing of risk assets in response to a geopolitical agreement that resolves the immediate trigger of market stress without necessarily addressing the underlying conditions that created it. The pattern appears with striking consistency across decades of financial market history and across a wide variety of geopolitical contexts. The most instructive early modern example is the Munich Agreement of September 1938. When British Prime Minister Neville Chamberlain returned from Munich, having secured Adolf Hitler's signature on an agreement that, in exchange for the cession of Czechoslovakia's Sudetenland, appeared to guarantee peace in Europe, the financial markets responded with euphoria. British stocks rallied, sterling strengthened. The Bank of England breathed a visible sigh of relief. Breathe for our time. Expressed in political terms, the same sentiment that financial markets were expressing in price terms. 11 months later, Germany invaded Poland. It had purchased time for Britain to rearm, as Chamberlain actually intended, and for Germany to consolidate the position it had secured. What markets had priced as resolution turned out to be intermission. The 1973 Paris Peace Accords, which ended direct American military involvement in Vietnam, produced a similar market response. American stocks rallied on the announcement of the ceasefire. The sense of relief at the end of a decade of costly, divisive military engagement was genuine and widespread. 2 years later, North Vietnamese forces captured Saigon. The peace with honor that Nixon had announced turned out to be a staged withdrawal, followed by the conclusion of the underlying conflict on turns in strategic interests. Markets had priced a resolution. History recorded a deferral. The 1994 agreed framework between the United States and North Korea, in which North Korea agreed to freeze its nuclear weapons program in exchange for energy assistance and a pathway toward normalization, produced another moment of deal euphoria. The threat of North Korean nuclear weapons appeared to have been negotiated away. In 2002, North Korea announced it had been secretly developing nuclear weapons throughout the period of the agreed framework. In 2006, it conducted its first nuclear weapons throughout the period of the agreed framework. In 2006, it conducted its first nuclear test. The framework had not resolved the underlying conflict between North Korean strategic interest and American non-proliferation objectives. Some deals do hold. The Camp David Accords between Egypt and Israel, signed in 1978, produced a durable peace that has persisted for nearly 5 decades. The 1998 Good Friday Agreement in Northern Ireland has largely held through more than 25 years of subsequent stress. The pattern is that deals struck in the immediate aftermath of a crisis, under time pressure, without resolved underlying interests in the form of a memorandum of understanding rather than a comprehensive treaty, have a much lower historical success rate than the market euphoria that greets them would suggest. To assess the historical durability of the current US-Iran agreement, it's necessary to examine whether the underlying strategic interests that produced the conflict have been resolved or merely deferred. The structural conflict between the United States and Iran has been running in various forms since the 1979 Islamic Revolution. It has survived multiple attempts at diplomatic resolution. The Obama-era nuclear deal, known as the JCPOA, negotiated in 2015, which the Trump administration withdrew from in 2018, which the Biden administration attempted to revive, and which has been the subject of intermittent negotiation ever since. It has survived multiple rounds of sanctions, military confrontations, proxy conflicts across the Middle East, and now a direct military engagement that has produced the current MOU. The structural sources of the conflict have not changed. Iran seeks regional hegemony in the Middle East, the removal of American military presence from the Persian Gulf, recognition of its right to a nuclear program, and relief from sanctions that constrain its economic development. The United States seeks Iranian nuclear non-proliferation, limits on Iranian proxy activity across the region, continued American military presence in the Gulf, and the preservation of the petrodollar architecture that depends on Gulf security. These interests are not compatible. They have not been compatible for 47 years. The MOU does not resolve this incompatibility. It creates a 60-day window for further discussion of nuclear questions, questions that have been under discussion in various formats for over 2 decades without resolution. The historical parallel that maps most closely to the current situation is not Munich, which involved a genuine, immediate military threat that the agreement addressed temporarily, but the 1994 North Korea Agreed framework, which created the appearance of a resolved nuclear threat while leaving the underlying strategic interests in direct conflict. That framework lasted 8 years before collapsing. If the current US-Iran MOU follows a comparable trajectory and the structural similarities are substantial, the financial markets that rallied on June 23 may have repriced risk assets on the basis of a resolution that will take several years to reveal itself as a deferral. Oil markets have a specific and documented history of overreacting to geopolitical agreements and then reverting as the underlying supply and demand dynamics reassert themselves, or as the political agreements that triggered the repricing prove fragile. The pattern is most clearly visible in the oil market's behavior around the various phases of the 1970s Arab-OPEC relationship with the West. The 1973 embargo drove oil prices from roughly $3 per barrel to over $11. When the embargo was lifted in March 1974, producing the deal euphoria characteristic of these moments, oil prices did not return to pre-embargo levels. They stayed elevated because the underlying structural shift in the balance of power between oil producers and oil consumers that the embargo had expressed was real, regardless of the immediate diplomatic resolution. The 1990 Gulf War produced a sharp oil price spike from roughly $16 before Iraq's invasion of Kuwait to over $40 during the conflict. The successful completion of Operation Desert Storm, which liberated Kuwait and appeared to restore Gulf security, produced an equally sharp oil price decline. By the end of 1991, oil was back below $20. But the structural conditions that had produced the Gulf War, the power vacuum in the Middle East, the unresolved tensions between Iraq and its neighbors, the dependence of the global economy on Gulf oil had not been resolved. They had been managed for another 12 years until the 2003 invasion of Iraq reignited the underlying conflict. The current situation contains elements of both these historical templates. The immediate oil price decline on the MOU announcement is a classic deal euphoria response, markets repricing the geopolitical risk premium that had been built into oil prices during the conflict period. This repricing may be partially justified if the ceasefire holds even temporarily. The immediate supply disruption risk is reduced. But the structural conditions that drove oil to elevated levels before the deal, the fundamental tension between Iranian strategic interests and American Gulf security commitments, the ongoing vulnerability of Gulf oil infrastructure to Iranian military capability, the broader de-dollarization pressures on the petrodollar system documented in this series have not changed. The deal did not transfer Iranian military technology. It did not resolve the nuclear program. It did not alter the strategic geography of the Persian Gulf. Historical precedent suggests that oil market deal euphorias in comparable situations have had durations ranging from months to a few years before the underlying structural tensions reasserted themselves in prices. The bond market's response to the June 2030 deal announcement is more instructive than the equity market's response because the bond market, as this series has examined in detail, tends to price structural long-term conditions rather than immediate sentiment. When the MOU was announced, Treasury yields pulled back from their recent highs. This was the expected reaction. Reduced immediate geopolitical risk, lower near-term oil price expectations, and modestly reduced inflation pressure all argued for somewhat lower yields in the short term. But yields did not return to pre-conflict levels. They remained elevated on a structural basis, reflecting the ongoing fiscal concerns, the persistent inflation pressures, and the weak demand signals that had been emerging from Treasury auctions even before the conflict began. This is the bond market telling a story that the equity market's deal euphoria was obscuring. The structural conditions that were pressuring Treasury yields before the Iran conflict, the debt level, the deficit trajectory, the weakening foreign demand for U.S. government bonds, were not affected by the MOU. The conflict had added an additional layer of stress on top of already elevated structural stress. The deal removed the additional layer, it did not address the underlying structure. This is precisely the distinction that this channel's entire series has been documenting. The difference between immediate geopolitical events, which create volatility but resolve relatively quickly, and structural economic and monetary transitions, which play out over years and decades and are not resolved by diplomatic agreements. The bond market's failure to return to pre-stress levels on deal announcement is, from this analytical perspective, the most honest financial signal in the current environment. It is saying the crisis trigger has been temporarily removed, but the underlying conditions that made this system vulnerable to that trigger remain entirely intact. The 60-day timeline for nuclear negotiations established by the MOU deserves specific historical examination because it is an extremely compressed window for resolving questions that have been under negotiation for decades. The original JCPOA negotiations, which produced the 2015 nuclear deal, took approximately 2 years of intensive diplomacy following the preliminary agreement of 2013. The deal itself ran to over 100 pages of technical specifications about uranium enrichment levels, centrifuge numbers, inspection protocols, and sanctions relief mechanisms, details that required months of technical expert negotiation alongside political negotiation. The current MOU establishes 60 days for discussions on Iran's nuclear ambitions. This is not enough time to negotiate a comprehensive nuclear agreement. It is enough time to establish whether the parties are willing to negotiate a comprehensive agreement, which is a different and much more limited objective. The historical record on compressed nuclear negotiating windows is sobering. The closest precedent is the 1994 agreed framework, which was negotiated in approximately 3 months, longer than 60 days but still far shorter than the time required to address the underlying issues comprehensively. The framework addressed the immediate crisis trigger, the plutonium reprocessing program that had alarmed American intelligence while deferring the harder questions about North Korea's broader nuclear ambitions and the strategic interests driving them. The current 60-day window is likely to produce one of 3 outcomes: a preliminary framework agreement that defers hard questions to a subsequent negotiating round, a failure to agree on even preliminary terms that returns the situation to pre-MOU conditions, or an extension of the negotiating period that kicks the deadline further down the road. In none of these scenarios does the underlying structural tension between American and Iranian strategic interests get resolved within 60 days. The markets that price the MOU as a significant de-escalation are. The historical record suggests pricing an intermediate state rather than a resolution. Having examined the immediate deal dynamics through the lens of historical precedent, it's worth stepping back to place this moment within the larger framework this series has been building. The US-Iran conflict and its MOU resolution, or partial temporary resolution, is a chapter within a larger story. That larger story is the structural transition of the global monetary and geopolitical order that this series has documented across 8 previous videos. The petrodollar system, the bond market stress, the de-dollarization trend, the internal political fragmentation of the dominant empire. These are the chapter headings of that larger story, and none of them have been resolved by the June 23rd MOU. What the MOU has done, viewed from this perspective, is create a temporary reduction in the acute phase of the petrodollar vulnerability that the third video in this series identified as the most direct near-term structural risk to dollar reserve currency status. The Strait of Hormuz is open. Oil is flowing. The immediate visible test of whether American security guarantees for Gulf oil supply could be maintained has been temporarily passed, but temporarily is the operative word. The underlying question, whether the United States can and will maintain the security architecture that underpins the petrodollar arrangement over the coming decade, has not been answered by a MOU that creates a 60-day negotiating window and does not address Iranian military capability, Iranian regional influence, or the structural incentives that drove Iran to challenge the arrangement in the first place. The historical record of comparable moments where a declining empire manages a crisis successfully in the short term while the structural conditions driving that crisis continue to develop is that the short-term management buys time rather than resolving trajectory. Britain managed multiple crises in the 1920s and 1920s without any single one being the decisive moment of decline. Each managed crisis was followed by another. The structural trajectory continued through them all. The current MOU on this analysis is best understood as one managed crisis in a series, not as the resolution of the structural transition this series has documented. For investors and ordinary people trying to navigate the current environment, the historical framework applied to the MOU produces specific and actionable observations. The first observation is that deal euphoria in financial markets, while real and sometimes producing significant short-term returns for those who trade on it, has historically been a poor basis for long-term portfolio positioning. The markets that rallied on the Munich Agreement, on the 1973 Paris Accords, on the 1974 Agreed Framework, those rallies were real, they produced real short-term returns. And in each case, the investors who restructured their long-term portfolios on the basis of the deal's durability were poorly positioned when the underlying structural tensions reasserted themselves. The second observation is that the oil price decline following the MOU, while directionally justified given the reduced immediate supply disruption risk, is likely to be partially reversed if the 60-day negotiating window fails to produce a comprehensive nuclear agreement. The historical precedent of oil market deal euphorias suggests that the repricing tends to overshoot the fundamental improvement and that some portion of the risk premium that was removed from oil prices on June 23rd will be restored as the structural complexity of the underlying conflict becomes clear. The third observation is about gold. Gold fell in the immediate aftermath of the MOU, as reduced geopolitical risk and lower oil prices reduced the inflation and safe haven premium that had supported gold prices during the conflict period. This is consistent with historical precedent. Gold tends to weaken in the immediate aftermath of apparent geopolitical resolutions, and also consistent with historical precedent, the structural conditions supporting gold's long-term role as a monetary hedge, the debt levels, the bond market stress, the de-dollarization trend, were not affected by the MOU. The historical record of gold's behavior across comparable intermission periods suggests that the post-deal weakness in gold prices has historically represented a purchasing opportunity for those with a longer time horizon rather than a signal that the structural conditions driving gold demand have resolved. The fourth observation is the broadest. The MOU changes the immediate news cycle. It does not change the structural analysis that this series has built over 9 videos. The bond market knows this. The central banks continuing to accumulate gold know this. The finance ministries of countries continuing to build alternative payment infrastructure know this. The 60-day window will produce its own developments, positive or negative, that will generate their own market responses. But the map that this series has been building, the map of where the current moment sits within the longer arc of monetary and geopolitical history, is the same map the day after the MOU as it was the day before. The Strait of Hormuz is open today. 60 days from now, it may be open still, or it may not be. History does not tell us which. history tells us only that the pattern of deals struck at the edge of unresolved structural conflicts has a specific and consistent track record, and that the financial markets that celebrate those deals have historically overestimated their durability. The larger transition this series has documented in bond markets, in gold, in the petrodollar, in middle class wealth, in the weaponization of the dollar, in internal political fragmentation, in the historical timeline of reserve currency transitions, continues through the intermission. The map remains valid, the clock continues running. If you watched this entire series, you now have something that most people watching the news cycle don't have: a historical framework deep enough to distinguish between events that change the structural trajectory and events that are chapters within it. The Mo is a chapter. The series continues. Subscribe, because the next video will examine something the current moment has made urgent: the specific historical record of what happens to wealth in the 60 to 90 days after major geopolitical deals, and what investors who understood the pattern did differently from those who didn't.